The gap between the rich and poor in Singapore is widening. This is reaching critical proportions. It's a moral crisis. Singapore's GDP per capita is the highest in Asia, and basically the average person should at least feel rich or be rich, but this is not the case, right? And our wealth almost doubled that of Brunei, which comes in second place. And yet, the middle class feels poorer than ever. The biggest crisis amongst the people, especially the young, is that the inequality gap is widening every single year. Now, jobs, the ability to get married, the ability to buy property, that's a concern. So despite our international rankings, an average Singaporean still finds it hard to live day to day without worrying about our future. Take a look at this. The closer this number is to 100, the more unequal wealth is distributed. And the opposite is also true. A lower score means more equal wealth distribution. So in 2008, Singapore was at 57. And guess where we are right now? It was 70. Compared to all the other countries in this list, Singapore had the largest change in wealth inequality over this period, and not in a good way. And one of the reasons why is that the more money that you have, the more money you will make. So in this video, I want to take you behind the scenes and show you why earning your first 100K is such a turning point. I'll share what to focus on instead so that you don't get left behind, which is the case for many people when they don't have a plan. Most of the channels here on YouTube aren't Singaporean, and our goal here is to really help you accelerate your financial growth and freedom no matter your background. If you like this video or like any of our videos so far, could I ask you for a small favor? Please subscribe to this channel, and our commitment back to you is that we'll keep on producing these conversations, videos that are helpful no matter how hard it might be to talk about them. Thank you so much for being here. Why does your net worth explode after you hit 100K? A lot of people think that hitting that magic number suddenly allows you access to exclusive deals, higher returns, and that's how the rich keeps on getting richer. But here's the truth. The real reason why your money starts to snowball after 100K comes down to these two factors, and they have nothing to do with what you invest in or what private investments you have access to. The first reason is size of capital. So let's say you invest the same 5% return, but with two different amounts. If you invest $1,000, that's $50 profit a year. If you invest $10,000, that's $500 profit. Same percentage, but 10x more money. Now, if you invest $100,000, with 5% you get $5,000. Same principle, 5%, but way more money in your pocket. What's interesting is that the risk and effort still stays the same, but the bigger your capital, the bigger the absolute returns. That's why the rich keep on getting richer. They play the same game, but with bigger chips on the table. Let's say you're using one of Singapore's biggest and probably the best high-yield interest savings account, the UOB One. At first glance, they advertise rates of up to 5% per annum. Sounds amazing, right? But here's the catch. Those rates don't apply to all your money. They pay you different rates based on different chunks. For the first 75K, if you hit all the criteria like spending $500 a month and crediting your salary, you only get 2.3% per annum. For the next $50,000, you get 3.8%. And for the next 25K, you get the full 5.3%. But here's the thing, if you only have $5,000 or $10,000 in that account and you get a rate of 2.3% per annum, you only get a few dollars in a year, which doesn't really move this needle. But the person with 150K walks away with so much more money than the person with $5,000 in the same account. The bigger your capital, the more those percentages work for you. That's why your net worth starts to snowball after you hit your milestones, like 100K. Because at that point, the free money that you earn from your interest starts to pay for actual things like your food, utilities, part of your mortgage, and other day-to-day expenses. Meanwhile, those with less have to stick to a job to trade their time for money, while the rich keeps on getting richer by trading their money for money. The second thing that people miss is what Einstein called the eighth wonder of the world, and that is compound interest. Put simply, compound interest means that you earn interest on your investments and then you earn interest on that interest too. So you're not just making money based on your principal, but also on the growth that has been generated too. A picture says 1,000 words. So imagine you save $1,000 a month at 8% per year. It might take you 7 years to hit your first 100K, and that's a slow grind. But here's where the magic happens. Getting your next 100K after your first doesn't take you 7 years anymore. You now have 100K working for you. So your second goal of 100K again might just take 4 years now. The third, maybe just over 3. And once you hit 1 million, earning an extra 100K might just take over a year for you, all because your money is doing the heavy lifting and working for you. This is why building your first 100K feels painfully slow. You're pushing the snowball uphill, but once you hit that tipping point, the snowball starts to roll down on its own, and that's where the compound effect kicks in. That's why so much advice at the beginning is about scrimping and saving your dollar. Every small win stacks up until you reach escape velocity. Then your money works harder than you do. Before we get into how to reach your 100K faster, here's one important piece that often gets overlooked, but it's actually quite common and a rapidly rising trend. In Singapore, about 78% of affluent families are planning to pass down wealth to their next generation, with an estimated of $166 billion expected to transfer over the next decade. This figure includes forms like property down payments, joint investments, family trust, and other early financial support structures. Common ways parents help accelerate wealth for their children. And this is increasingly becoming more commonplace for normal Singaporeans too, who aren't high net worth but feel the pressure on behalf of their children, knowing that Singapore is increasingly becoming harder and harder to build a life from scratch. It's a strategy to build a scale of capital earlier so that future generations could save on hard work and time of building up your first base, which often takes the longest. And compound interest has more time to do its work. Of course, not every family has the ability or desire to do this, but it's worth understanding many families don't get rich by chance alone. They plan, they talk about money, and they create structures so that wealth can grow together. If that's not possible for you right now, don't worry. You still have other levers that you can pull on your own. So keeping these two factors in mind, scale of capital and compounding, let's break down what you can do to save to your first 100K so that you don't get left behind. Now, the biggest tip of saving your first 100K is to start investing now. Because here's a secret that most people don't know. You make the most money in the last few years. The biggest gains come at the end, not at the beginning. So if you start off too late, you might risk being too old to enjoy the payoff. Let's say you're earning a salary of $60,000 a year and you plan to save 20% of that. That's $12,000 a year. At an average return of 8%, saving $12,000 a year could amount to over $730,000. But just 4 more years could push that over $1 million. That's the power of starting now and giving your money time to compound. Time is your greatest advantage. It matters more than how much you start with. So even if you don't have 100K ready, start wherever you can. The sooner you start, the sooner your money earns interest, and that interest will earn you more interest. So if you've been waiting for the perfect time, the best time was yesterday, and the next best time is today. And if you're ready to take action but you're not sure how, you can check out my Freedom Acceleration Toolkit. This is the exact guide that Darren and I used, which enabled us to eventually quit our corporate jobs to travel full-time together confidently, without financial pressure. Next is to increase your investment amounts. Now notice I didn't say the best place to park your money. It's not about picking the best stocks or going all in crypto, hoping that you become from a thousandaire to a millionaire, although I know of some people who did. While that makes a difference and can happen in some cases, In most cases, it doesn't happen. So in your early years, in your 20s or 30s, the thing that is going to drive your results is increasing the amount that you can invest. So imagine you're investing $200 every month and you do so for the next 30 years with a 10% return, you just get up to $452,000. And if you get 12% return, you get almost 700K, which agree a huge amount of difference. But instead of trying to optimize for the stock market, can't really control that anyway, you focus on increasing your income instead. Now that's in your control. So maybe negotiating your salary, jumping jobs, which has shown to be increasing your income more than just sticking in the same goal, investing with your partner, or earning more through a side business. And let's say instead of getting an extra 2% on the stock market, you double your investment because you increase your income. So instead of 200 every month, you now invest 400, then you get to 900K. Although there are many different ways to build wealth, my personal way to go about it is to focus on things that you actually can control on a day-to-day basis, and that is your income. And you can do so while investing a small amount so that you get the hang of it and get the practice of letting your money sit there and let the compound interest work for you. In that way, when you do have a ton of money and you want to invest a lump sum, you won't be starting from scratch because you already had a head start. As the saying goes, you can't save your way to wealth. So don't underestimate how powerful it is to combine investing more with giving your money time to grow, and together it can have a huge impact on your net worth. So if you like this video, here are another two that you might enjoy: financial literacy and other high income skills that you can learn today.